Have you ever thought about how a massive stroke of good luck could actually be a curse in disguise? It sounds like a total paradox, right? But in the world of economics, this happens all the time. Today, we're going to get into this really fascinating economic illness. It's called Dutch disease. Think of it like this. Can winning the lottery actually ruin you? We've all heard stories about that happening to people, right? Bad decisions, chaos. Well, imagine that on the scale of an entire country. A sudden windfall of wealth, like discovering a giant oil field, can trigger a very specific and, honestly, a pretty counterintuitive economic sickness. So what exactly is this thing? It's called Dutch disease, and it's an economic puzzle where a country's good fortune, like finding a ton of oil or gas, actually ends up hurting its other industries. The name itself was actually coined by the Economist magazine way back in 1977. They were looking at what happened in the Netherlands after they found a gigantic natural gas field in 1959. And instead of just getting rich, they watched their manufacturing sector just mysteriously start to wither away. I mean, how is that even possible? To really get it, we need to look at the anatomy of the sickness. We've got to break down how this good fortune can literally infect an entire economy. Okay, so economists Corton and Neary gave us a great way to think about this. Just imagine the economy is split into three big pieces. First, you've got the booming sector. That's the oil, the gas, whatever the big discovery is. Second, you have the lagging sector, and that's usually manufacturing. And third, there's the non-tradable sector. Think of things you can't really export, like construction work, haircuts, or restaurant meals. The whole infection really spreads in two main steps. First, there's what's called the resource pull. That booming oil sector starts offering huge wages, right? And it just sucks all the best workers and talent away from the other industries. Then you get the spending effect. All this new oil money floods the country. People start spending like crazy, and that drives up demand for all those local services. Now, this creates a total double whammy for the manufacturing sector. I mean, they get slammed. On one side, their own costs are going up because they have to compete for workers and pay more for local services. But on the other side, all that foreign money pouring in makes their own currency way stronger. And suddenly, the goods they're trying to export become way too expensive for anyone overseas to buy. They're just squeezed from both ends. And here's the really crucial part: the long-term damage. This isn't just some temporary slump. Once those factories close down and all the skilled workers leave, that knowledge is just gone. As this quote gets at, you can't just flip a switch and bring manufacturing back to life. The skills, the know-how, the whole industrial ecosystem, it's dissipated, maybe for good. So if this is such a clear and present danger, how can you spot it coming? Well, let's take a look at the key warning signs, the symptoms that can help you diagnose the disease before it's too late. Okay, a classic telltale symptom is something called price divergence. You'll see the price of services, things you can't easily import, like housing or a meal out, they just skyrocket. But at the same time, the price of goods you can import, like a new TV or clothes, stays pretty low. This widening gap between the two is a major, major red flag. This dashboard here kind of lays out all the key indicators for the doctors of economics. You're watching for a currency that just keeps getting stronger, you're looking for wages in that resource sector just pulling way ahead of everyone else, and of course, a shrinking manufacturing base. You don't have to memorize this, but the big takeaway is that the symptoms are actually pretty clear if you know where to look. All right, theory is one thing, but let's check out some real-world case files. This is where you can really see how this plays out, from amazing cures to, well, complete and total collapses. So let's go back to patient 0, the Netherlands. After that huge gas discovery in '59, their currency, the guilder, strengthened. And by the 1970s, their manufacturing exports had absolutely cratered. But they did eventually find a kind of cure. In 1982, they created something called the Wassenaar Agreement. And this was basically where unions, employers, and the government all came together and agreed to hold back on wage growth to try and make their industries competitive again. Now, for the absolute worst-case scenario, Venezuela. I mean, they made pretty much every mistake you could make. They took their oil money and spent it immediately on consumption, not on long-term investment. They artificially propped up their currency at the super high value, which just annihilated any industry that was left. And when oil prices finally crashed, there was nothing left to fall back on. It was a complete economic implosion. And this really brings us to two totally different paths, two extreme examples. On one side, you have Venezuela. They chose to spend their windfall right away, and it led to collapse. And on the other side, you have Norway. which chose a radically different path. They decided to save and sterilize the money. The results, as you can see, could not be more different. So how on earth did Norway vaccinate itself against this? Well, they created a massive sovereign wealth fund. And here's the crucial part. They invested all of their oil money outside of Norway. This move, which economists call sterilization, kept their own currency from getting too strong. Then they made a super strict rule. The government could only spend the investment returns from the fund, never touch the original capital. It is, without a doubt, the gold standard for avoiding Dutch disease. But, it's not always so simple. It's not always a clear-cut diagnosis. In places like Canada and Australia, which also had huge resource booms, there was this massive debate. Was it true Dutch disease, or was it just a Dutch affair? A temporary side effect of a boom that was actually, on the whole, a good thing. The diagnosis can get really complex. So, given everything we've seen, what's the actual policy prescription? If you're a country that just hit the jackpot, how do you prevent or cure this economic illness? Well, there's what you could call a trinity of cures that most experts agree on. First, do exactly what Norway did. Create a giant savings account, a sovereign wealth fund, that invests all the money abroad. Second, you have to lock it down with super strict rules so politicians can't just raid it when they feel like it. And third, you use the returns from that fund to invest back into your country, making your other industries more productive and competitive for the long haul. But here's the real kicker. The cure is simple on paper, but it is politically very, very difficult to pull off. It means saving a massive windfall instead of spending it on popular things like tax cuts or new programs. It's a true test of a country's discipline and its long-term vision over that temptation of short-term gratification. So let's wrap this all up with a final, kind of forward-looking thought about the future of this resource curse. See, this isn't just about oil and gas anymore. As the world shifts toward green energy, you have to wonder, could we start to see a green Dutch disease? What happens when a country becomes a superpower and exporting, say, green hydrogen or lithium for batteries? The new risk factors are right in front of us. Nations with incredible hydropower potential, countries sitting on mountains of critical minerals for batteries, or the future exporters of green hydrogen. The source of the wealth is changing, for sure, but the underlying economic machine, the strong currency, the spending effect, that painful squeeze on other industries, that mechanism is exactly the same. It's a timeless economic paradox, and it just might be finding a new host for the 21st century.